Infrastructure is having a moment. Once considered the domain of institutional investors and private markets, it's now becoming a central theme in public portfolios. From data centers powering AI to the energy systems driving the low-carbon transition, infrastructure is evolving and expanding. So what's behind this surge in investor interest, and how should we be thinking about infrastructure's role in the global economy and our portfolios?
Outside of the shale oil and gas boom in the early aughts, early 2010s, this is the best growth environment we've seen for infrastructure. You really cannot be bullish AI without being bullish on the power and the energy providers for it.
Welcome to The Bid, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm Oscar Pulido. Coming up, I'm joined by Balfe Morrison, head of listed infrastructure strategies, to explore the growing relevance of infrastructure investing. We'll unpack the differences between public and private market access, discuss why this is a golden age for infrastructure, and examine how megaforces like AI and energy transformation are creating new opportunities. We'll also look at which sectors and regions are drawing attention and what investors should keep in mind when adding infrastructure to their portfolios. Balfe, thank you so much for joining us on The Bid.
Thanks for having me.
Balfe, we're here to talk about infrastructure and investing in infrastructure. It's safe to say this is a theme that has become more popular in recent years, a theme that investors are having to consider more for their portfolio. So maybe before we dig in more detail, why don't we start with just the definition? When we talk about infrastructure, what are we talking about?
So when we think about infrastructure, we're thinking about the companies and assets providing really the most important services in the world that are required to maintain our way of life. To get more specific, we're talking about the utilities providing electricity, water, and gas for heating. We're talking about the oil and gas pipelines that are providing the gas to the utilities and providing the gasoline and transporting the jet fuel for our cars and airplanes. We're talking about data centers where a lot of our data is stored, but also is where AI is effectively generated. Tower companies that are responsible for transmitting all of our mobile data. So when we're making calls or working on our iPad, we're talking about on the transportation side, airports, which are the gateway to both kind of leisure travel as well as business travel. And then also toll roads and railroads, which are the critical infrastructure for both commuter and freight travel. So a lot there, but these are the companies providing the most critical base services for our quality of life. The other way I think about it, these are the companies that we sometimes take for granted and only really think about when stuff goes wrong or they get too expensive. But for the most part, the companies that we're investing in are providing a really good service at really fair prices.
You mentioned these are essential services, and a lot of the examples that you gave are things that we intersect with in our day-to-day life in multiple ways. I think when we talk about investing in infrastructure, it's historically been associated with investing in private markets. And that was the way you could invest in infrastructure. And it was accessible perhaps to the high-end, high net worth investor or institutional investor. But increasingly, the ability to invest in infrastructure is also now accessible through the public markets and more accessible to retail investors. So talk to us a little bit about maybe some of the similarities and differences about investing in infrastructure through public and private markets.
So I'll start with the similarities and go into the differences. And there are more similarities than differences. And so when you think about listed versus private infrastructure, the underlying assets are the same. A gas pipeline, a data center, a solar farm, a railroad, the asset makes their money the exact same way if it's owned by a company in a listed fund versus owned in a private fund. Regulated the same exact way. So the assets are the exact same, which is really the most important thing. In terms of returns, over a long period of time, pretty highly correlated. And in thinking about infrastructure as an asset class, these companies and these assets tend to generate more of their total return from dividends and income as a percentage of the total return versus the broader market. In terms of differences, the most obvious ones, the listed funds are going to have a little bit more liquidity. Where we see the biggest difference is in sector composition. Think about the listed infrastructure space. a big part of the market cap, call it like 50%, give or take, is in the regulated utility space. So the companies that own the poles and the wires and the power generation. It makes up a very big part of the listed infrastructure universe globally. That sector composition is more weighting towards utilities, a little bit more onto the data centers on the private side is really the biggest difference. We don't think one is better or worse than the other. I'm really excited about what we're seeing in the utility sphere. I'm biased there, but data centers are great too, and they're seeing a ton of growth. And we think that for investors that are able to gain access to either or both, we think of them as complements in a portfolio, infrastructure allocation, but both are great. And over a long term should return comparable figures.
And as you were talking about the similarities and differences, I was thinking how they both sound like interesting investment opportunities, with perhaps the difference in sector composition being the thing that you have to take note of as you're choosing between the two. Larry Fink, BlackRock's chairman and CEO, has described this as a golden age for infrastructure investing. Why do you think he uses that term? And do you agree with that term when you think about the space?
I would definitely agree. And I'd say outside of the shale oil and gas boom in the early aughts, early 2010s, this is the best growth environment we've seen for infrastructure. There are a lot of positives happening that are affecting pretty much all the sectors that I laid out to start the conversation. I'll start with the energy and electricity demand. So here in the US, we've effectively had no electricity demand growth for the better part of 2 decades. That is changing. We see electricity demand in that low single-digit range going forward, maybe even a little higher in certain regions. It doesn't sound like a lot, but it is a lot more than zero. What is driving that? A lot of it is the energy needs of AI. So the hyperscalers, Meta, Google, Amazon, et cetera, are spending hundreds of billions of dollars on AI infrastructure to develop their own models and to help others on their AI journey. A big part of those investments are the data centers that consume a ton of electricity and energy to effectively generate AI. And the companies that are benefiting from this are the utilities. My colleague Will Su on a previous Bid podcast mentioned how electricity demand from data centers is growing at about a 20% clip annually expected through the end of the decade, growing from about 4% of current U.S. electricity demand to about 10 to 12% by the end of the decade. That is impossible without the utilities that I mentioned, which are a big part of our universe here in the listed infrastructure space. But it's not all just about AI and utilities. One other dynamic we're really excited about in terms of the infrastructure growth going forward is the natural gas pipelines. Between a more supportive administration as it relates to natural gas pipeline infrastructure growth, the surplus of cheap natural gas that we have here in the U.S. that's allowing more exports to our allies in Europe and growing Asian economies. And frankly, also the energy needs domestically associated with AI, we're seeing a boom in natural gas infrastructure growth. So to quantify it a little bit, per the Center for Energy and Environmental Analysis, which is a climate-focused think tank, there is 67 billion cubic feet a day of natural gas pipeline infrastructure being built today. That probably means nothing to you and most of the people listening. But to put it into context, that infrastructure is going to be coming online between this year and 27. That is about 3 times the amount of natural gas pipeline infrastructure that was built between 2022 and 2024. So it is a big amount of natural gas pipes being built. That is going to result in a lot more growth in the natural gas space. Those are 2 of the most promising and exciting dynamics in infrastructure today, but many others going on as well.
Well, you mentioned Will Su, which was a great callback to an episode that we did. One thing that both you and he did was throw out a quantity and a number reflecting some growth aspect. In your case, you were just talking about natural gas pipeline build out. Will talked about the sheer energy demand that was being created from all of the build out of data centers and the artificial intelligence theme. So it's clear that this is more than just a regular theme that we're talking about. We're talking about exponential type growth that is driving infrastructure. Maybe talk a little bit more about how AI and infrastructure intersect. This sounds like it's going to be a pretty persistent relationship for at least the near term, but maybe even longer.
The way we think about it, all this energy demand from AI and developing AI is very positive for infrastructure, particularly energy infrastructure. You'd also invert it and say that if you're bullish AI and bullish adoption, you have to be bullish power and utilities because you cannot develop AI without the power and without the electricity. And so it is really positive. And it's not just me, the listed biased infrastructure guy saying it. Listen to the developers and the operators themselves. Schneider Electric, which is a key AI infrastructure component supplier, did a survey recently, U.S. data center developers. And in that survey, they asked, what are the big bottlenecks to developing data centers? And which again is where the AI is generated. 92% said it is procuring power, accessing the grid. To put in context, only about 80% said it was getting the chips and getting the land. The electricity and the grid is the bigger issue. So this is a big deal. And getting even more specific, more recently, Amazon CEO in the latest earnings call noted the biggest impediment to growing their AI business and franchise, AWS, is the power. And then finally, the last thing I'd say, Oracle, which is partnering with OpenAI now and a big part of the Stargate enterprise, noted that in their most recent earnings call, the biggest impediment to moving faster, again, is the data center, which is mostly a power issue. They actually said they have no issue getting GPU chips. So it's just to kind of emphasize, this is a very symbiotic thing, a relationship. And so it's impossible to be bullish AI without being bullish on the growth for utilities and power sector. And so it is a really exciting time to be in the sector. And you really cannot be bullish AI without being bullish on the power and the energy providers for it.
We've talked about AI. We've talked about energy. You mentioned natural gas. Infrastructure has a lot of different types of sectors that comprise this theme. So what other areas of interest are you seeing?
You're right. It is not all AI, not all energy. We look at plenty of other sectors. One other that we haven't really talked about is the transportation space. That is, from a market cap perspective, about 30% of the listed infrastructure universe. A big part of that is actually the North American railroad sector, where we actually saw a very interesting transaction get announced and proposed a few weeks ago. Union Pacific, the kind of Western Railroad, announced an agreement to acquire Norfolk Southern, which is a big Eastern railroad. This could be a big mega deal, $200 billion plus enterprise value combined entity. It's really exciting for the sector for a number of reasons. The rail sector has really struggled the last few years. We do think that a transcontinental merger would reinvigorate growth for the sector, and that growth is likely going to come from taking market share from other forms of transportation, namely the trucking sector, which still represents over 2/3, quote, 70% of total freight revenue is the trucking sector. Rails are only 7%. We think that this deal could potentially lead to further M&A activity in the sector, which again would reinvigorate growth, probably lead to further multiple expansion and just better performance for the sector. So, that's another area that we're pretty excited about within the listed infrastructure space.
Well, and it's an interesting contrast because when we talk about AI, we think about the new economy and the economy of the future. And when you talk about railroads, I think about like the Industrial Revolution and just the original foundations of the economy when you're transporting goods from coast to coast. But that still takes place. And as you said, there's an opportunity for the railroad sector to perhaps eat into some of the revenue that is right now taken by the trucking industry. Balfe, when you think about infrastructure, you mentioned all these essential services. These are essential services, I think, regardless of where you are in the world. So are there regions in particular that catch your interest? Is this more of a U.S. story? Are there areas outside the U.S. that people should be paying attention to?
Yeah, definitely. We invest globally. We are actually really excited about the European utility sector. And that's a region and a sector where they aren't necessarily seeing the AI kicker that the U.S. utilities are seeing. To put it in perspective, Vertiv, which is this kind of AI infrastructure data center darling, they highlighted that they're growing their U.S. and Asian business in the 30 to 40% range. In Europe, it's high single digits to frame where Europe is on its data center and AI build-out journey. But there are still really exciting things happening in the European utility space. And then from a decarbonization perspective, Europe is still resolute and focused on decarbonizing the grid, building out renewable infrastructure. That's also pushing up the growth on the European utilities as well. And thinking about the U.S. versus the European utilities, what we also like is the U.S. is a very high growth, dynamic market. Consensus earnings growth for the S&P 500 over the next 3 years is about 12%. We'll see if it gets there. But if you look at the broader European market, it's only 6%. So we think that as the market recognizes this dynamic of kind of the higher growth utilities with lower risk than the overall European market, we're actually really excited about the re-rating opportunity for the European utilities, even though there isn't really an AI data center energy inflection story to date.
You mentioned Will Su earlier, but as you're talking about European utilities, you're reminding me of some of the comments that Helen Jewell has made on previous episodes about the opportunity in that European sector, and not only the income that it pays, but that its earnings growth that also is what makes that sector interesting. Balfe, if we zoom out, you've talked to us about infrastructure as a theme. You've compared the similarities and differences between the private infrastructure space and the public infrastructure space, which is more your day-to-day. For somebody who's considering an investment in the public infrastructure strategies or sectors, what should they be thinking about when it comes to their portfolio?
Sure. So we think this is, I hope it's coming through, really exciting. The word generational, I think, is apt. Opportunity to be investing in infrastructure kind of broadly. When you think about the listed space, historically, it's provided inline returns, so equity-like returns to the broader market over a long period of time with lower volatility and higher income. That's historically. What we see going forward, we think earnings are accelerating. In terms of risks and the like, this is still a defensive asset class, meaningfully outperformed in April during the kind of the Liberation Day peak tariff and trade war risk period. So we're not really that worried about the economy. We talked a lot about AI, and I think there was a lot of, even the people who believe that the growth is going to come driven on the back of a lot of this accelerating energy demands from AI and data centers. There's some concern that what happens if AI the projections don't turn out and maybe the adoption rate isn't as fast or the hyperscalers stop investing. What we really like is that the sectors and the utilities and the pipeline companies have contracts with the hyperscalers. And so there is not going to be any sort of a earnings cliff or big earnings hit if the AI story is not what we all think it is. And so you're much better protected from that kind of risk versus, I think, other parts of the kind of AI infrastructure or picks and shovels value chain. So we think earnings growth is going to accelerate. It's still going to be defensive and you're still going to get that above average yield. So we think it's a great time to invest and a great fit for any equity portfolio.
Balfe, as I said at the beginning, infrastructure is definitely a theme that we're talking more about these days than we had in what I can remember, at least going back. It's a theme that seems pretty persistent. You've helped us learn a lot more about the different sectors and the different ways and opportunities to invest in this theme. Thank you for doing that with us, and thank you for doing it here on The Bid.
Thank you.
Thanks for listening to this episode of The Bid. If you've enjoyed this episode, check out my conversation with Helen Jewell on episode 212, where we discuss how low-carbon infrastructure will play a role in the evolving energy landscape. And subscribe to The Bid wherever you get your podcasts.
This content is for informational purposes only and is not an offer or a solicitation. Reliance upon information in this material is at the sole discretion of the listener. In the UK and non-European Economic Area countries, this is authorised and regulated by the Financial Conduct Authority. In the European Economic Area, this is authorised and regulated by the Netherlands Authority for the Financial Markets. Reference to the names of each company mentioned in this communication is merely for explaining the investment strategy and should not be construed as investment advice or investment recommendation of those companies. For full disclosures, go to blackrock.com/corporate/compliance/bid-disclosures.